Hello and welcome to Real Deals Live. I am your host, Nicholas Neveling, and thank you for joining this webinar hosted in association with TMF. And today we are going to be focusing on the dynamics of the European investor base. Over the last 3 decades, the European investor base has evolved from local pockets of LPs supporting domestic managers into a diverse mix of investors with different objectives, priorities, and manager selection criteria. So how then should GPs approach this diverse set of potential investors? And how can managers direct their fundraising efforts to the pockets of investors where their offering is most likely to gain traction? Over the next hour, we are going to grapple with some of these topics and explore the reasons behind the transformation of the LP universe and discuss what it means for managers. Joining me on today's broadcast, I'm joined by 3 expert guests to help understand the above-mentioned dynamics. My first guest is Peter Flynn. Peter is the Chief Executive and founder of Candela Capital, a UK-based fund distributor and advisor focused on the mid-market and VC space. Peter has worked in the alternative assets industry for close to 20 years, including spells at Pantheon Ventures, Fleming Asset Management, and NM Rothschild. Peter, really lovely to have you on this afternoon. Thank you for your time. So you've been in this game for some time now. What would you say has been the most significant change in the constitution of the European LP base over the last 20 years?
Oh, thanks, Nicholas. Well, I had the pleasure of working for many years in the United States as well before coming back to Europe. And I think it would be sort of characterized that 20 years ago, the US institutional investor, even a relatively small institutional investor like the endowments and foundations, were light years ahead of their European equivalents in sophistication and understanding of how to generate added value from private assets. That gap has very significantly narrowed over the past 20 years. And the most sophisticated European investors are every bit as sophisticated and sensitive to latest areas of added value as their US counterparts. It's probably fair to say that the US market is still a bit deeper in terms of opportunities and the number of both GPs and LPs. But Europe has very significantly closed that gap. And there are certain areas, particularly in some of the technology areas, where Europe has a lead. And what's most interestingly, and in matters of renewables and ESG, Europe probably has a lead. So you've seen the depth of European investors change very significantly. You've seen the sophistication change very significantly. Probably what's not changed, though, is the speed that both sets of investors move. So you find that your US equivalent, if they find a new opportunity that sits into their sort of value bucket, they will go very quickly after it. Whereas typically speaking, their European counterpart will take a bit more time, will get to understand, will get to feel that they know the manager a little bit better. But that's probably a cultural difference between Europe and the US. But in terms of sophistication, you've seen the narrowing.
Thanks so much, Peter. So clearly the European market has evolved. It's a lot more sophisticated, deeper, and a lot more diverse than maybe it would have been from what you've sketched out. And I think that sets the scene really well, and we'll dig into a lot of those themes later on. But before we do, I'd like to introduce my second guest and welcome Anya Grenner to the broadcast this afternoon. Anya is the Head of Sales for Fund Services Luxembourg at TMF Group. Anya's been in the Luxembourg fund services industry now since 1993 and has worked in the alternative fund space since 2004. She joined TMF in June 2020 and previously held a number of senior leadership roles in operations and business development teams. Thanks so much for joining the discussion today, Anya. Okay, this is a subject we will be returning to later in the program, but again, just to set the scene and provide some context, what is the opportunity for the non-EU manager, and why should a third country manager seriously consider accessing the EU LP base when, as Peter outlined, you do have a very deep and sophisticated US market? What's the opportunity there if you are a manager who's considering tapping some European LPs?
Yeah, the European market has always been a large market with regards to pension funds, insurance company. It's just that before the majority of those entities used to invest almost everything into quoted assets. So bonds, equities, cash, you name it. It's just the matter of mentality and culture. Now, obviously, with the low interest rate environment, which is going to stay at least also over the next couple of years, the insurance companies, other institutional investors have to embrace higher yielding investments like alternative funds, obviously, and they haven't really sort of got a choice anymore. So already in the past, there has been quite an increase in investing in alternative assets. And a lot obviously has gone into European funds as well. But there is a lot of hunger also here in Europe by the insurance companies, pension funds, and all those institutions to invest abroad. And obviously that is the American market in particular. So a lot of money has actually gone already into the United States, but also in other countries. And if I look, for example, I was just looking at some of the some data from the German institutional investors. They are still far away from, for example, a US pension funds with about 22% of being invested in alternative assets. But it's rising already now from 22 to 26%. And I guess while Germany obviously is a big market, it'll possibly be similar for other institutional investors. And a lot of this one is actually going into funds that have been raised by US asset managers before. They would have invested in the vehicles that the US asset manager would have had in the United States or Cayman Islands. Now that is obviously changing. So it's more now that the US asset managers are coming to Europe for European vehicles so that the European investors actually can invest into the assets that US investors are sort of providing them with. So I think the European market from an asset manager point of view is extremely interesting because a lot of dry powder out in Europe, which has not been used so far. And I think now with COVID, that is even more the case because there's a lot of money that hasn't been invested over the last year and money that has to be deployed also this year and fairly quickly.
And you're really interesting. Just one thing I wanted to check in with you on. You mentioned how there is appetite from European institutions to start investing in product from managers brought from overseas. Would it be fair for me to say that that has been a relatively recent shift, whereas in the past, perhaps institutions would have focused on managers in their domestic markets? Is this very much now an international market with respect to the product that European institutions want to back?
Yeah, I mean, there has been for sure a trend over the past 10, 20 years already for European investors not focusing on European products, but not wanting to invest in vehicles that are outside the EU. And I think the AIFMD obviously is a major driver of that trend. But I think European investors sort of looking at what the yields are basically driven into products that are bringing the results that they actually require sort of to fill their pension gaps. So, and that is very often driven through US managers, not only, I mean, it could also be in the younger jurisdictions in Asia, but there's a lot of hunger for investing also outside Europe. And I think that is still fairly new, let's put it this way.
Great, Anya, thank you. So clearly Europe, we're in a growing market here if you're a manager in the market looking to raise money. Thanks so much. We'll jump into a lot of those themes that you raised a bit later. But before we do, I'd like to introduce our third and final guest. Really a warm welcome to Manfred Dietrich, who is the head of investment funds and asset management at law firm Norton Rose Fulbright, Luxembourg. Manfred has worked in the Luxembourg fund services industry for around 20 years now, both in practice and as an in-house lawyer, and he has advised on all aspects of fund establishment, structuring, and operation. Welcome, Manfred. Anya mentioned the AFMD, and I wanted to ask you about that just again to set the scene for the rest of our discussion today. It was first implemented in 2013. It's obviously had a profound effect on the European LP landscape. Could you briefly describe, I know it's a very complicated piece of legislation, but could you briefly describe exactly what the directive is and why it's been so influential, in our industry?
Thank you, Nicholas. I'm very happy to be with you all. Yes, Alternative Investment Fund Managers Directive. What's that piece of framework? Because it's not only the directive; it's all we call it level 2 measures, so the regulations below it directly implementing certain things in the member states. It is basically a catch-all for what is not public funds. We all know under the UCITS brand. In order to set the scene that there's a common framework for the regulation on managers. That's the big difference with the UCITS. UCITS is a product, and Alternative Investment Fund Managers Directive is a directive and framework which is regulating the manager and not the product. That gives, of course, on the one side, the liberty that this can catch much more than just certain products, and it does, and that was the intention. So basically, if you apply the definition of what is an alternative investment fund, you come to the conclusion that it is an alternative investment fund, then you are immediately, let's say, kind of in the question, do I need an alternative investment fund manager which is authorized, or am I sufficiently small in order to have an alternative investment fund manager, which is what we call a sub-threshold. So definition AIF, applicable to everything which is coming across as a fund, meaning very briefly spoken, you raise money from a number of investors, person to an investment policy with the aim of investing it and to bring the return to the investors. That is an alternative investment fund. And of course, there is then certain carve-outs or certain limits. I mean, securitization is clearly not an AIF, and you have, of course, funds which are dedicated to a pre-defined group. Family office is not an AIF per definition, things like that. But in general, it's a catch-all, and it applies to whatever comes across in Europe with looking like, smelling like, tasting like, based on this definition, a fund. And then the question comes up, the manager of this is then the AIFM per definition. And the next question is, if you're in the European Union, whether you are above that threshold or whether you are below the threshold. Above, you need authorization and a fully fledged service, or you appoint someone who has that license. And below, you are in a registered form, and there the manager is, let's say, of course, not under the requirement to have the same substance and the same things to comply with as the fully fledged one. And then, of course, there's the broad space of those managers which are not sitting in the European Union. They are also AIFMs, but they cannot apply for the for the fully licensed version 1. They are not really the sub-threshold ones. They're just AIFMs per definition. And that is, of course, let's say we see that later on, something where certain limits then exist, certain particularities exist when it comes to distribution and marketing. And we will deal with that. An important point is, of course, when you have an authorized manager, it has more substance, it has more requirements to comply with, but, and that's the big advantage, this manager has the right to distribute the funds it manages as AIFM across the EEA and the EU via marketing notification process, which is relatively good working. I mean, nothing maybe is perfect, but I think it proved to be very efficient and functions well. So you can then, with a structure on a pan-European basis, really attract investors in every EU country. And that with a passporting system where, except for small differences, maybe to fees for the one or the other country or things like that, really at a level playing field for European Union, go into the markets and look for the LPs you would like to look for. Whereas when you are not in the profit of the passport, then you need to do it, let's say, either by specific rules, a national private placement regime still in place. That is applicable for those which are in the European Union, but also those who are coming from outside under specific rules on a country by country application, which can be for the one or the other country a bit more burdensome and the others a little bit easier. We have seen that, but it is something which is also an advantage because it is, of course, giving you the liberty to decide upon certain using of maybe local structuring in European Union, or to rely on your structures and you say, okay, the markets I want to cover, I can cover with the one-to-one registration. So I do not need to afford the cost for a fully licensed AIFM servicing entity in Luxembourg or setting up my own structure. That's all things which are, let's say, giving us a little bit of an idea. And as I speak here, you can see basically an entire industry, not only a private equity, venture capital, real estate, but also, let's say, a hedge fund industry, which is working outside the UCITS space, was let's say, in the need of complying with that. I think the past years showed that the directive and what was intended, I think, was a success because it set a level playing field, and it functioned in general very well, so that there was also the possibility for European managers, but also for European structures to find a stronger place maybe in the world, even though certain things might be perceived relatively burdensome when you come from outside. But I mean, the world has also evolved in the past years after several crises into seeing things a little bit different than it was maybe before. And at least we can just say that there's still a very good possibility to work with the AIFMD, and there is a good way of arranging products, either for managers coming outside Europe or for managers sitting here, attracting investors from outside Europe. So it's both ways, and it works well, and there's a solution for a lot of things, and not let's say kind of a building walls. That was certainly not the intention, but it has. It didn't have the outcome either.
Great. Sorry, I'm going to jump in there.
Yeah.
I think you've really set the scene well. As I said, it's quite a huge topic and maybe a bit unfair to ask you to explain it in 5 minutes. But I think we've covered the bases there. I think we understand very clearly the benefits of passporting and the level playing field. And we'll certainly go into the options available to managers if they're not going down the AFMD route later on in the conversation. So introductions out the way, I think we've certainly set the scene. Before I go into some of those points in a bit more detail, if you are in the audience today and you'd like to ask a question, there's an opportunity to do that. So please just use the question tool, and we have set aside time at the end of the hour for our speakers to take some of those points. So please take advantage of the opportunity to tap some of their expertise. But let's move on, and I'd like to come back to Peter. And I wanted to really just try and segment the European investor base in a little bit more detail. So before we delve into the mechanics of what's required to tap EU investors from a regulatory point of view, I mean, could you outline, who are they? How do you segment the LP base when you're advising your clients, and how do these sort of various clusters differ from each other with respect to how they operate, what their return expectations are, and their broader appetite? Over to you, Peter.
Apologies, normal muting problems. I just want to pick up a couple of points that Manfred took. And I think we need to understand the political point of which AFMD came out of. It came out of the 2007-8-9 financial crisis, which was a profound crisis for European investors. And that profound crisis provoked a very strong political reaction. And it would be fair to say that if you look at what is required in financial regulation for professional investors, which is essentially what AIFMD is trying to do, is that it took a very different view from the US or even the British, even though the British were part of the EU at that time, by coming up with a rules-based structure and be very, very cumbersome in terms of costs to play in the market and take advantage of the marketing passport. And so if the goal of regulation is to get the right products into the right financial institutions from the right managers, I would say that AFMD has been a failure and remains so. It is a barrier to entry. It is protectionist. It is clunky. It is poorly designed. People like Manfred have made a fantastic job of trying to make it simple for investors to use this terribly badly drafted bit of regulation, but essentially it didn't work, and I'm rather hopeful that AFMD 2 is going to sort of unwind some of the worst aspects of it. But if you then take the goal of what this is trying to do, and I'll come to your question in a minute as to the sections, but I'm coming to this point. Essentially, you've got a series of institutional investors that want to tap into different products for different reasons. Clearly, the number one desire for many investors is alpha, but yield is incredibly important for others. Appropriate diversification, tapping into the most able managers in terms of the mix of return, risk, and yield. Would reach a better sort of efficient solution for the average pensioner and the average a buyer of an insurance product. And AFMD has essentially been a barrier for that and has added costs. So I know of many US managers who just sort of, the US, it's just, we understand the regulatory environment that we're in, and it's just too cumbersome to go to Europe, which is a great shame. Because there are methods, and Anya and Manfred will I'm sure make those very clear, whereby the best US managers, the best overseas managers, can get access to European investors. But it's been a drag. It's been inertia. it's added inefficiency. Having said that, I tend to look at clients not in the categories that the world looks at them, which is sort of insurance company, banks, fund of funds, family offices, but I look at them in terms of their need. What do they need? And most of them long-term are after alpha. They're very concerned about variability. How we measure variability in private assets is controversial. It's clear that just because you have a quarterly valuation, and then claiming that an asset that isn't high risk or highly variable is clearly a nonsense when the underlying value of those assets is varying very significantly within that quarter. And so then you start off with essentially within private equity, which is a sort of diversification away from equity, from early stage venture through to later stage venture to growth to development capital to buyout to large buyout. But now you've added into that mix real estate is widely available in a private capital form, as is infrastructure, as is private debt. And then so what you're trying to do is get the right products into the right investors at the right mix. Most of those investors know exactly what they want. So essentially, actually, most products are applicable to most investors. Though you'll find that insurance companies will tend to have not very much in the VC area, but they will have some, and depending on their solvency requirements. And then you'll have family offices that will have a high percentage in high risk, high alpha assets, and a lower percentage elsewhere. So it's a bit of a melange, and what the requirements for all of us to do is to truly understand what are the needs of the investors and try to get the right products and the right managers into it in a manner of which all parties understand the risks that they're taking. So that's how as a sort of placement agent and someone involved in distribution, we would see it. And I know that an administrator or a lawyer is likely by definition to see it incredibly differently.
Peter, thanks very much. Some really interesting views there, and quite critical on AFMD. Maybe just before we move on, I just wanted to provide an opportunity for Manfred and Anya to come back on that. Do the points that Peter raises with about AFMD and some of the critiques, do those sound fair? Would you challenge anything, or would you have a different position on anything that Peter's mentioned there? Anya, maybe, yeah, just wanted to provide.
And so just to add, Anya and I used to work together and used to be colleagues together. So
of course,
there may be a slightly more, if there is a robust dialogue between the two of us, it's on the basis of love, not enmity.
It's to be encouraged. But Anya, yeah, I just wanted to give you an opportunity to come back on any of those critiques that Peter raised about the AFMD structure and regulation.
Yeah, I mean, the one thing for sure, the AFMD was not the most beloved piece of legislation when it was introduced. For sure not. I know that in particular on the private equity scene, it was seen as extremely burdensome because it also changed the way private equity used to work. And a lot of people also said, well, there is basically no merit in there. And just because I'm not a UCITS fund, you cannot just throw all the non-UCITS fund in one basket. To a certain extent, I also sort of share that there have been a lot of burdens, and I am also aware that there were also US funds that said, just because there is sort of one or two sort of prospect clients or investors in Europe, I'm not going to go through the hustle of putting something together just for them. It's becoming so complicated. If I cannot do a PPR private placement, then I'm just not going to do it. So there were cases like this. But the AFMD has also had its merits, undoubtedly. It has been making, and has been giving a certain harmonization here in Europe, how things are being done, certain controls. At the end, we always have to remember that the AFMD was not done for or against private equity or real estate. It was more targeting sort of the hedge fund world. after the crisis, 2008, 10 up to 12, basically. So I understand sort of a lot of the criticism. Also, Europe is Europe. You don't talk to Europe as such. You talk to the Germans and the French and the English and the Spaniards and the Italians. And as UCITS has not been sort of stamped out of the ground in 1 year. It's been shaped over decades now. I think we are now with UCITS 5, if I'm not entirely mistaken, even though I'm not a UCITS expert. Also AFMD 1, call it the original AFMD 1, which was started in 2013, has been, as usual, sort of implemented slightly different in the different EU countries. So it is, as always in the beginning, a bit of a patchwork, actually. So every country sort of looking at how it can sort of put it into work for its economy and sort of its investors, its landscape. So this is actually something which has made it also more difficult. And I think it's a bit of a science almost, sort of to see sort of what do you need if you want to distribute in this country or that country or the third or the fourth country, which are not the same. So Manfred is probably going to go into more detail on this one. But AFMD 2, I hope we're not going to have AFMD 5, but AFMD 2 is definitely looking at harmonizing a little bit more, so it makes it actually easier. But for the moment, when AFMD 1 was started in 2013, it had a very clear timeline as well as to what was supposed to come when. And then also came Brexit that made it a little bit more complicated because it slowed down certain developments that should have actually come, which then were basically sort of stopped until Brexit came. Now it's there. And I think this is also why also AFMD 2 is now coming into place, but it will gradually change. And these years have been a little of a teething phase, and there was sort of a lot of sort of loopholes as well. You could say loopholes, but it left you certain flexibility, sort of depending on how you look at it, a certain flexibility of how you were going to approach the European market if you wanted to raise funds in Europe. And I think nowadays also ESMA sort of has seen what's out in the market, how is it being done, what works, what doesn't work. So to a certain extent, 2021 is probably going to be a new game changer again with regards to distribution. And I'm sure Peter is probably going to say a couple of words on that one as well, Manfred as well, but I think it will actually change things.
Anya, thanks very much. Let's move on. And Manfred, I think that leads on nicely to the question I was looking to put to you. Anya mentioned that there are different routes to the European market and certain flexibility. And as I understand it, there are certainly two pathways that non-EU managers can follow if they want to raise capital from European LPs. So just wanted to ask if you would be able to outline firstly what AFMD requires from non-EU managers marketing funds into the EU, and how that compares to going down the alternative private placement route, and whether those two routes are still going to be available for the foreseeable future.
Okay, thanks, Nicholas. I think just to briefly add on, Anya, if we see what happened in the UCITS world, which was a directive in 1985, and how AFMD was implemented and set up, I think there's a long year experience in doing that, which, let's say, really profited everybody from an implementation of a new directive in a new field, which functioned quickly, quite well, and in the meantime even better. So that is, let's say I grew up, I used to say, in the UCITS 1 world still, and having made the experience of the developments there, I think the AFMD is a relatively good framework from the beginning not having the same, let's say, lacks as the UCITS had. But that's also a question of experience in the European Union with that UCITS directive. Now coming back to the question, you mentioned there is different routes. Well, the direct route, I would say, remains the one for a non-EU manager. He has a structure potentially in Delaware, Cayman, or wherever, or Channel Island, and with that structure, you could say, okay, I'm gonna figure out which countries in the European Union are the ones I want to look out for LPs, and let's say testing appetite will be possible as long as you do not, let's say, already kind of market your things. Otherwise, you need to apply with a notification procedure for each of the countries where you would like to really market. That is, I must say, when it comes to Luxembourg, a relatively straightforward process. When it comes to Germany, it is a much more difficult, or burdensome is maybe not the right words, but it is more intense, let's call it like that, because every European Union country has the right for this one-to-one marketing to say what they would like to see for it. And in Germany, they said that they would like to have this non-EU manager with his non-EU fund, for instance, to have a depository. Now, that is, of course, something which would normally not be existing. And for Luxembourg, that is not a requirement. I mean, the minimum requirements which the directive set out should be met in each of the country's rules when it comes to the one-to-one from non-EU to EU notification, is basically the certain informations to investors which are set out, and to register and to say who will be, let's say, doing the acting on the ground. That's very briefly spoken. And there has been some gold plating in certain countries, which is up to them, but not in Luxembourg and in other countries neither. So that's one route which remains, of course, for the time open. The second route is, of course, to say, well, I look for the appetite, and then I decide whether the appetite makes me think that either I set up my own AIFM, and then with a European structure, investing potentially in parallel. Master feeder situation could be a little bit difficult, because if you're a real master feeder, then your passporting rights when you are a EU AIFM feeding into a non-EU structure are not the same. So meaning the passport cannot be used in order to invest solely in master funds which are outside the EU. But if you use a third-party AIFM for a European structure, or you use your own when you think you have enough appetite to justify the cost for it, then you can set up structures in the European Union, investing either in parallel or in a fund-of-fund basis into your funds, which you have set up somewhere else, and then you can attract the EU investors. Now, you asked about what will be in the future. Will that be continuing? There's, of course, the so-called third country passport, meaning the possibility provided by the directive that potentially non-EU countries could be considered as being equivalent, and then have authorized AIFMs being set up in these countries. This does not only require a statement from ESMA, but also a decision by the Commission, and this has not been triggered. We do not know whether it will be triggered. Very difficult to say. A little bit the problematic is that certain countries have foreseen that their private placement regimes would be falling apart, and then potentially the first way I described would also fall apart, meaning the one-to-one notification. That is, of course, what the industry and the associations do not consider as being useful, and it would also not be, I think, in the advantage of a strengthening of the European management and products or funds sector. So I think the European Union will heavily consider that. And when we speak about the public consultation of AIFMD 2, which has just been passed, questions around that have been asked, and I think the positions, at least I can speak for where I was involved, were very clear to say we think that what we have is a good thing, and probably we should not touch on that. I'm not going into the details when it comes to the third country passport.
Thanks, Manfred. I'm going to move along now. I was going to ask you to go into a bit more detail about what the decision about structuring in the EU entails, but I think you've covered a lot of those points in your answer there. So Anja, I'd like to come to you and just ask about the real sort of granular technical detail. And could you just for my sake, could you specifically unpack the roles of the administrator, the depository, and the alternative investment fund manager, and what they all mean and how they all interface with each other?
Maybe the landscape has actually changed quite a bit over the last years. Just I remember sort of when I started, the players, the service providers here in Luxembourg for alternative assets were basically larger banks, so custodians that also sort of happened to do fund administration, so central administration on the one side. And on the other side, you had a lot of sort of smaller administrators that were in particularly responsible for administering SPVs, because the majority of the funds were still in non-European countries, or they were Delaware, Cayman, Jersey, Guernsey, basically, and they were just using Luxembourg for the SPVs because of the double trade treaties. That actually changed I would say sort of in particular when the first funds were set up in Luxembourg for alternative assets, so 2004 for the CCAR, 2007 for the specialized investment funds, and that brought in a wave of basically Jersey and Guernsey based administrators that had a different approach, but they usually only did the administration part. So quite a couple of companies or sort of asset managers actually sort of divided their business to, on the one side, the banks, to continue to do the custody piece, and on the other side, sort of moving over from the administration to those service providers. So it's sort of split out anyway already at some stage. Nowadays, what we see more and more again is that those service providers that used to do central administration, so I'm talking here about administration, accounting, domiciliation, sort of everything that goes along there. Then in particular, when the AIFMD started in 2013, sort of ventured into offering these services which it didn't do before, and that is basically the depository. So we called it custody, now it's a depository. And then also to a certain extent, fairly quickly, the AIFM. So today, there's a lot of these service providers that actually sort of do the three. So in central administration, depository and AIFM work, not necessarily sort of all in one single sort of legal entity, but they provide it. And the reason simply is that the more funds are coming to, or asset managers coming to Luxembourg, also from non-EU countries that are not necessarily sort of that familiar with, on the one side, these three service lines, and on the other, do not really sort of want to look out for the one, let's say, central administrator out of 80, or one custodian bank out of 200, or another AIFM amongst sort of 160 approved one. So today, you basically sort of try as a non-EU manager going into Luxembourg to find a service provider that does it basically all. And logically, sort of, and that's something which was my full understanding, if if I know as an asset manager coming from the United States that I have to appoint an AIFM, which is called the Alternative Investment Fund Manager, my first thought is going to be, oh my God, is he now, or are they now doing what I'm usually doing? Are they taking away my job and sort of what's left over for me? Are they going to do valuation, for example, and not me anymore? So this is usually the part which is sort of closest, I would say, to the heart of our clients, the asset manager, and making them understand sort of what we are doing and that the portfolio management will still remain with the client, while it could actually sort of well be that they would act as advisor officially, while the portfolio management is going to stay with the AIFM. Is a process which obviously sort of is not that easy to make understand. In particular, if you do have the second option, sort of depending on the size of the fund, where the general partner would actually remain sort of the sub-threshold manager. Now we are talking about a fund size of, let's say, maximum sort of 500 million. It can become actually quite confusing. What would be even worse if then sort of you were then talking to one company sort of doing this one, and to another company doing the central administration, and a third company doing the depository. Now my experience is, as the depository function, for example, is more of an oversight function, that, okay, it's a must, you have to have it, but the majority of our clients say, yeah, I mean, you know, if you can sort of do this as well, it's fine. You know, just please don't bother me too much with this piece of the entire chain of work. So what we have actually seen is that the AFM is obviously the most important, and the question is there sort of who does actually what, and there are different options driven by different sort of models and needs and sizes. And in that respect, AFMD is not that evident. Also because certain functions can actually be delegated to the managers, sort of through the asset managers in certain cases. Concretely speaking, for example, in the UK and the US, the majority of the asset managers are actually regulated. So a Luxembourg AIFM can delegate the portfolio management to them. The majority, for example, of the asset managers sitting in Switzerland are not regulated. So the portfolio and the risk management function would have to sit in Luxembourg, and then the portfolio manager would act as advisor to the AIFM. So it's not that evident actually, but the second part, the central administration, obviously on a day-to-day is sort of key as a support function for accounting, etc., etc. And then the depository is always, I always call this like the stepchild. You know, I wouldn't actually say that loud to anybody who is sort of doing depository, but it's very often considered because it is a controls function, which to a large extent sort of goes on a day-to-day basis between the accounting section and the COSEC section of the administrator and the depository. If they need information, they will contact the administrator in the first place and not go back to the client. So if everything goes well and there are no issues, the asset manager would not necessarily sort of be that much in contact with the depository, unless you have a board where there is a presentation of the depository, and then it usually sort of goes away and then for the next 3 months. So this is something that we see, and obviously, let's say you are an asset manager come from the Midwest in the United States, you just are not going to talk to sort of, you know, X different entities, 10 that are potentially providing depository, 10 that are potentially providing AIFM service, and 10 that are potentially sort of providing the central administration function. Very often the way it goes sort of from a pure pragmatic point of view, that the asset managers obviously sort of for kickstarting a project talk to their law firms in their home country, who then in a lot of cases today, and that's sort of probably also sort of one of the merits of the globalization, then they have an office also in Luxembourg, and then the Luxembourg law firms then sort of do a pre-selection, recommend certain administrators, and obviously sort of with the preference of sort of giving it all into one hand. So that the asset manager can really sort of concentrate on what he's supposed to be doing, which is not the coordination of service providers, but the management of a portfolio.
Okay. And yeah, sorry, I'm just going to jump in there. I think so much detail and obviously so much to consider. And we've got a bunch of questions, and I just wanted to come back to Peter quickly, just to understand what all those technical requirements mean from a strategic point of view. So yeah, Peter, Anja, and Manfred have helpfully sort of addressed much of that technical detail, but I wanted to ask you, if you are a manager, what does this mean for you about how you target your LP base? What does it mean for you if you're a smaller manager? And do you sort of see a two-tier fundraising market where smaller managers will look at it in one way because of the regulation, and larger managers see it in a different way and adopt a different strategy as a result of that?
Yeah, I mean, let's be really honest here. The people who pay for this are the pensioners and the insurance companies. They pay for this massive, depository administration legal structure, which does almost nothing to improve the security or the decision making. So it's a sort of, you compare it to the US, which has, if I take a really great European manager to the US, I can do so for hundreds of dollars, which is they need to deposit their document with FINRA. They need to sign on with a distributor who knows the rules of distribution in the US, which are complicated. I've done various examinations to do that, but once you've hit that hurdle, the US is an open market. And so the US pensioner and the US insurance user actually benefits from the world's best ideas. The best Chinese, the best Asian, the best European, the best US. In Europe, you've got to be a manager. KKR, Carlyle, the big guys can afford to come and afford to pay for Anja and Manfred and all the other hundreds of people that need to be involved. But if you're a small life science manager doing some incredible work in cell gene therapy, which is the therapy behind most of the vaccines, it's virtually impossible. Now, you can, until August, rely upon the national private placement regime. You probably can't rely upon reverse solicitation anymore because the test for reverse solicitation is so high. So your answer is completely appropriate. There is a completely bifurcated approach. We're talking to a US manager, which is a world leader in decarbonisation. I might be able to do a bit of pre-marketing to some Europeans, and we might be able to have a bit of a dance and get through that. But in terms of, are they going to get registered and regulated in every single country that they need to? They probably can't approach anyone in Italy. They probably can't approach anyone in France, certainly not without significant cost. And so, the European investor, the European pensioner is missing out on these best managers. And for Manfred to describe AFMD as better than the complete mess of the UCITS introduction as a good thing is slightly odd to me. And I don't think if you compare to where you could be in terms of proper harmonization across each country, and then access to the best managers being protected and appropriate assets, we're light years away from that position. So it's a cost, and it's a cost borne by the people who can probably least afford to bear it.
Manfred, just quickly, do you want an opportunity to come back there on that point that Peter raised?
Yeah, well, I understand, of course, the frustration or the certain critics expressed. I just, let's say, saw it from the point to say it could have been worse. Of course, that is not what satisfies all what you are dreaming about. or what you would see as, let's say, from a managerial perspective, as the most efficient way of doing it. Unfortunately, this is not always what politics then, let's say, in the end do. So we need to maneuver very well to not have a situation which is, let's say, making it even more burdensome, and to slightly improve what we have, while knowing that, of course, in a world which would be even more ideal, I would have also certain things where I would say, well, if I could, I would do that differently. But yes, it's I know there are things, there are hurdles to take, but I think to a certain extent they can be taken. And of course, and we see that smaller managers, for instance, have also they struggle sometimes to do certain things because they cannot approach people, investors, in the same way, even though their products might be very good. So we need to, let's say, pay attention to keep open certain levels of acting for managers, and take care that this is preserved, and that we have a level playing field, but not only for the larger ones, but also a level playing field in all.
My turn to struggle with the mute button. Thanks very much, Manfred. Okay, we are approaching the hour, but I would like to get these questions in. We've had a couple of interesting ones. So brief answers, please, speakers, if you can. Okay, the first one. As an AFMD light manager, so a manager registered below the threshold, are you at a disadvantage, apart from the size of your funds, when approaching European institutionals? So, for example, are there any regulatory or policy reasons why European pension funds, insurance companies, banks, etc., would prefer a fully licensed AFMD instead of an exempt Europe-based manager? Hopefully that makes sense. Manfred or Anja, maybe I'll direct that to you. Manfred, that sounds like it could be in the weeds of the legislation. Would you be able to give us some kind of answer on that one?
Yeah, sure. And I will be very brief so that Anja can step in. I think generally for the assessment of each of the institution, it depends also on the sophistication they have. In general, it should not be a problem. Might be the one or the other smaller in general, where it is maybe not to their use. And then, of course, it could raise questions from compliance there. But I think I made the experience for bigger ones, also speaking about development banks, for instance. This is not raising any concerns.
Okay, thank you. Peter, sorry, did I see you wanting to come in there?
It was just to agree with Manfred on that. The most sophisticated investors are agnostic as to whether you're below the threshold or above the threshold. They're after the products, and they're professional investors, and they'll do their own due diligence to make sure you're appropriate for their program. So I've not seen it personally.
Anja, and then quickly, I don't know if you had anything to add, Anja, to that point.
Yeah, I think the major hurdle is, if you are talking to larger institutional clients, is more that they have a certain minimum investment, which at the same time is not supposed to be sort of going about, let's just say 40-50% of the total assets of that fund. So sometimes it's a bit of a catch-22, but I must say, so because we also have a couple of those funds which are sub-threshold, so there's no official AFMD. The regulators sort of have pretty much made sure that what an AIFM actually performs from a risk and portfolio management services, also control function, et cetera, is then also put on the shoulders of the general partner. So just saying that it doesn't comply and we shouldn't invest in sub-threshold because it doesn't do what an AIFM would be doing, is at least nowadays not the case anymore. For sure not. It's
Thanks,
just shifted to another entity who is performing the same services as the AIFM.
Okay, great. Thank you very much. Another question here. This one relates to the point about AFMD2 providing some harmonization. What are the main benefits in a practical sense versus the original AFMD? Is anyone able to take, Manfred, would you be able to take that one again?
Sorry, I
beg your pardon, let me say that again. So this relates to the points raised around the harmonization of AIFMD2. What are the main benefits in a practical sense versus the original AIFMD?
Well, probably to the disappointment of the audience, this is something where we cannot yet say because we are only in the public consultation phase. So we can a little bit looking into the crystal ball, what the Commission will make out of what has been the feedback of industry and associations, etc. So I would at that stage unfortunately not be able to tell this is this or this is this what will be coming up. Yeah, unfortunately that is for the time being, but 2021 will show us certainly more, and especially once we have potentially a draft of an AIFMD update, which might be only at level 2, so not necessarily in the directive itself.
Okay. Thank you, Manfred. And then one last one before we close. Peter, this relates to a point that you raised earlier, and it is a question. So is national private placement then in practice not really a workable solution beyond August? Is the regime still in place? Does it fall away? That seems to be something that was picked up. I think it'd be important to clarify that if we can.
I don't think we can definitively. It's a working assumption from many participants given the timing. The one thing that we do know is that reverse solicitation has been tightened up to the point that if you are an existing manager, identifying that you have a successor fund and you're a third country manager would definitely fall within reverse solicitation. So, you know, KKR 7, you're in KKR 6, you could say, yeah, I'm very interested. If I'm bringing a young, you know, a new life science fund from a third country in, it would be, and I think this is probably appropriate. It is virtually impossible to prove reverse solicitation. How did they know that you were in the market? How, you know, without having breached some additional marketing rule. So then you are relying on the national private placement regime, some of whom are going to continue. But the working assumption is it's all going to be wrapped up in AFM2. We don't know what that will look like. The hope is that we'll have high levels of harmonization, and so it's probably like one of the things about Brexit is that you wanted to make sure that when you had passporting approval, you did it before the 31st of December, and you introduced your ideas, and then you can continue talking. You probably need to bring it forward, or, maybe we're all going to be surprised and a wonderful piece of sort of change of regulation happens, which enables the best managers to get access to the right pools of money. But I would be cautiously pessimistic.
Okay. Manfred, I don't know if you had any points to add there on the future of MPPR. Does this come back to the third country passport? Does that need to be in place before MPPR is turned off altogether? Any insights you can provide? Yeah.
As Peter said, he's pessimistic. I let's say playing in that case the good advocate and say, well, potentially we can also see that in the interest of a fostering of the market, it could be that a commission will, of course, not force someone to establish national private placement regimes or to keep, but maybe to level up the playing field so that those who may not have this in place or not in place, that it works very well, would be a little bit motivated to do so. because it has been a positive outcome in the countries where it exists. That would be, let's say, the optimistic part of the thing. Of course, we do not know, and I think that it would be a difficult thing after a certain period of time to have only the possibility to say, well, I need to use a fully licensed one, otherwise I cannot go into European Union market. That is, from my perspective, an outcome which we should not have, and which we should do everything which is in our force to avoid.
Okay, great. Well, look, we have run slightly over time, but not too much. Apologies to all the listeners whose questions we couldn't get to. I'm sorry, we've just run out of time, but thank you very much for your input and your attention. And I'd also like to extend a big thanks to our speakers, to Anja Grenner, Peter Flynn, and Manfred Dietrich. Very interesting conversation, and we appreciate your time and input. So thank you again for listening, and good afternoon.